I've pulled all my money out of Treasuries. Hello, members, super savers, and Bond Course fans. I hope you're healthy and well, and welcome back to our weekly update. This is something that some of you have told us over the past several weeks. And the three most frequently cited reasons for pulling out of Treasuries were concerns around DOGE, the Department of Government Efficiency, and our new administration, the growing budget deficit, and the possibility of default. So, with that in mind, here are the three topics that we'll be covering in today's video. 1. What's really safe if Treasuries aren't anymore? 2. Which Treasuries rose the most and which ones fell this past week? And 3. What are the yield expectations for the upcoming week's 3, 10, and 30-year Treasury auctions? Plus, what are the highest yielding opportunities for new issue agencies, corporates, and brokered CDs right now? And for those of you looking to test out a new broker, in this section of today's video, we'll be sharing with you E-Trade's latest promotional offer. As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. What's really safe if Treasuries aren't anymore? Let's begin by taking a look at each of these three most frequently cited reasons for pulling out of Treasuries. So reason 1. DOGE and our new administration. Listen, there's a lot happening right now, and it can feel like events are overtaking each other. So it's no wonder that some of the super savers and super savers in our community are feeling a bit uncertain and confused at the moment, regardless of which side of the political spectrum you may be on. And during times like these, I think it's important for us to keep a level head and to remember that other than the Republic of San Marino, which is one of the smallest countries in Europe after the Vatican City and Monaco, our country has the oldest living constitution in the world. It also wouldn't be a stretch to say that our constitution is not just the best known constitution in the world, but it has also been battle tested over 2 centuries, and our constitution clearly establishes 3 branches of government: the legislative, executive, and judicial branches. And it is our Constitution and the checks and balances across our 3 branches of government that have kept our country together in the worst of times and in the best of times. And in our mind, there's no reason to think that this time will be different. Moving on to reason 2, the growing budget deficit. Yes, it is still growing, as we've shown you from these recent numbers. And yes, we're as concerned as you are that this will not be sustainable in the long term. But we had at least some positive news on this front last week when Treasury Secretary Scott Bessent announced that the Treasury would not be increasing auction sizes and would stay committed to a strong dollar. While this alone clearly won't solve our budget problems, it could complement Bessent's stated goal of achieving a 3% growth rate for the U.S. economy. And as we talked about in these recent videos, so long as our country's GDP grows at the same pace or faster than our debt, that is already a big first step towards reining in our budget deficit issue. But it's clearly still early days, so we'll keep watching carefully along with everyone here in our community. Reason 3, the possibility of default. As our Diamond NestEgg regulars know, my general assumption is a no default scenario when it comes to US Treasuries. This has always been my assumption, even when all the presidents after Clinton spent more than they took in. And this continues to be my assumption with President Trump. If anything, should the current administration follow through on its promises of cutting some of the fat from the federal government, which they seem to be doing at the moment, this should keep us further from a default rather than bring us closer. But let's say that you are much more pessimistic and you have pulled your money out of Treasuries. This still leaves you with the question of finding a safe haven to shelter your hard-earned savings. If you put your dollars into money market funds, CDs, or even under the mattress like some of you have told us you have, or that you're considering doing this, which is what prompted today's update, here is what you should know. It's not easy to escape a certain dependency on the US government. First, money market funds. The overwhelming majority of money market funds hold at least some treasuries and other securities that may be explicitly or implicitly backed by the US government. In fact, some money market funds only hold treasuries. Second, CDs. So if the US government were to default on its treasuries and promises, the likelihood that we would see a true banking crisis that might affect your CDs would be very high. And remember, CDs are considered safe because they are FDIC insured. But the FDIC is backstopped by the US government, meaning that ultimately when all else fails or is exhausted, the market relies on the US government to step in to save those CDs. Third, cash underneath your mattress. That cash is issued and ultimately backed by the full faith and credit of the US government. If it weren't, it wouldn't be worth much more than monopoly money. Which means that if you really think that treasuries are not safe for one or all of these reasons, then money market funds, CDs, and dollar-denominated cash under your mattress may not really be the safe haven you've been looking for either. None of them might be worth very much, if anything at all, in the unlikely event that our country ever decided to pull their full faith and credit of the US government promise from our treasuries. Even your equities portfolio would likely suffer, because if the US government were to default, faith and trust in our US companies would also most probably be lost. Your only real options in this case might be gold, other precious metals and commodities, foreign currencies, and cryptocurrency, keeping in mind that all of these have a very different risk and liquidity profile than treasuries, money market funds, CDs, and dollars under your mattress. As for us, I've said before that we continue to ladder our T-bills and hold onto our long-term treasuries because we continue to believe in our Constitution and our three branches of government. Because in these early days, we have no reason to believe that the current administration is any more likely to default on our debt than previous ones. There is also one more point I'd like to bring up. We are at our core a financial channel, and in my mind, it is our job to answer your top questions. In the past, your top questions were about how to buy bonds, what happens if the US defaults, how does FDIC work, what happens if Schwab and Fidelity collapse? In recent weeks and months, though, your top questions have been about President Trump getting rid of FDIC, President Trump and your money, President Trump and your Social Security, Elon Musk and your treasuries. We actually had to upgrade our backup storage recently because of all the emails we've gotten on these topics, which we welcome. And as we've done in the past, we will continue to give you the facts and the financial perspective. And as appropriate, we may tell you about what we're doing with our money and then leave it to you to decide what to do with your money. Everyone's financial journey is different. As I always say, be aware of what's happening, but try to turn down the noise and don't change your investment strategy unless you have a strong personal reason to do so. And for us, personally, not much has changed, regardless of who is the president of the United States of America, either now or in the future. So, with that in mind, let's move on now to the next section of this video. Which treasuries rose the most and which ones fell this past week? As we so often do at the end of the week, let's grab our rates from the Treasury's daily Treasury par yield curve rates page and compare Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. And here's the increase or decrease in rates over the past week. Increases in rates are shown in black, and decreases in rates are shown in red. Treasury yields had a bit of a roller coaster week again, with the 1 month unchanged, the 2 month through 3 year up, and the 5 year through 30 year down. The 1 year and the 2 year were up the most, at plus 8 basis points and plus 7 basis points respectively, mostly on indications of a still solid labor market and the reduced likelihood of additional rate cuts in the near future. And the 20 year and 30 year were down the most, at minus 13 and minus 14 basis points respectively, primarily driven by concerns around tariffs and the Middle East. So short end up, long end down. Looks like the curve is re-inverting a bit, but it may be too soon to read too much into it. So we'll pause that thought here for the week and continue the discussion when we have next Friday's numbers. Now, let's take a look at Treasury yields from this past Friday versus the beginning of the year. This row shows where rates ended this past Friday. This row shows where rates were on January 2nd of this year. And this row shows the increase or decrease in rates in 2025 so far. Again, increases in rates are shown in black and decreases in rates are shown in red. The 1 month, 3 month, and everything 5-year and longer are down, with the biggest changes to be seen on the very long end, driven primarily again by tariff worries and the recent flight to safety. Treasury yields across all the other maturities are slightly higher than where they started the year, with the 1-year T-bill up the most at 8 basis points. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page, as I mentioned earlier. All sources are linked below in the first pinned comment. Do keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. Now that we've covered Treasury yields from this past week, let's move on to the next section of today's video. What are the yield expectations for the upcoming week's 3, 10, and 30-year Treasury auctions? Plus, what are the highest yielding opportunities for new issue agencies, corporates, and brokered CDs right now? Here we are at Treasury Direct's upcoming auctions page. If we scroll down, we can see that all the weekly T-bill and CMB auctions are happening as usual. And if we scroll down further, we can see the 3-year T-note, the 10-year T-note, and the 30-year T-bond will be auctioned off as well this upcoming week. None of these are reopening auctions, so the coupon is still to be determined on all of them. At the time of this taping on Fidelity's platform, here's what the coupon and the expected yield are for the 3-year T-note auction. And here's what the coupon and the expected yield are for the 10-year T-note auction. And here's what the coupon and the expected yield are for the 30-year T-bond auction. Do keep in mind that all of these numbers can and usually do change all the way up to the time of the auction. So that was Treasuries. For those of you who may be interested in other types of bonds for a bit of a higher yield potentially, here's where the highest yielding new issue agency bonds stand at the time of this taping, with the highest yielding one from Federal Home Loan Banks at 5.82%, with a first call date in May 2025. Here's the CUSIP for those of you who may be interested. For corporate bonds, there is quite a long list again this week on Fidelity, with yields that are a fair bit higher than last week. The highest yielding one is from Jefferies Financial Group at 6.5%, with a first call date in February 2026. Here is the CUSIP for those of you who may be interested. For brokered CDs, rates still remain on the low end. The highest yielding one is from Morgan Stanley Private Bank at 4.6%, with a first call date in August 2025. So, as I touched upon towards the beginning of this video, my daughters came across E-Trade's latest sign-up bonus on Instagram last week. They've been hunting for interesting money topics for their new YouTube channel. Many thanks to all of you who tuned into and commented on Ava's 6% savings account video last time. This week, it's Caitlin's turn. So if you're interested in checking out E-Trade, check out this latest E-Trade video here. I've also linked it below for easy reference. All right, members, super savers, and bond course fans, I hope you enjoyed this video and learned something new. And as always, if you want to learn more about bonds and how to build a stable, predictable income stream in retirement, especially while bond yields are quite attractive, then check out this video here on our beginner and intermediate level bond courses. As usual, I've linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. And see you again very soon with more brand new wealth building content for your financial journey.